Two people walk into the exact same bank on the exact same day. One has $43 in their checking account. The other has $4.3 million. Same marble floors, same logo on the wall, same smiling employee at the front desk. But they are not entering the same world. One gets asked for identification 3 times. The other gets greeted by name before speaking. One waits in line. The other gets escorted into a private office with coffee already prepared. One gets charged $35 for overdrafting by $8. The other can borrow hundreds of thousands at lower interest than an average person pays on a used car. And the disturbing part is, this isn't corruption. It's policy. Modern banking quietly operates like a hidden ranking system, a ladder most people never see clearly, even while living inside it every single day. Because banks don't just store money. They categorize humans by risk, by income, by predictability, by assets, by debt behavior, by future profitability. And depending on where you fall inside that invisible system, the rules of life itself begin to change. Not metaphorically, literally. The cost of borrowing changes. The speed of service changes. The quality of treatment changes. Even the amount of forgiveness you receive changes. The higher your financial status climbs, the more friction disappears from reality. Tonight, we're walking through every level of that system, from the overdraft economy all the way to private banking and ultra-wealth access. Not motivational advice, not outrage, just the cold mechanics of how money changes the way institutions behave around you.
For millions of people, their relationship with banking begins with punishment. Not opportunity, punishment. Usually it starts young. A first debit card, a small checking account, a part-time paycheck. Nobody explains how the system actually works. You're told, use your card responsibly. But what nobody explains is that banks make enormous amounts of money from instability. A missed payment, a delayed paycheck, a low balance, a tiny mathematical mistake, and suddenly, overdraft fee, insufficient funds fee, late charge, interest penalty. A person who already has almost no money gets charged more money for being low on money. Which sounds irrational until you understand the business model. At lower wealth levels, banks often generate revenue through friction. Small penalties multiplied across millions of financially stressed customers become extremely profitable. And the people most vulnerable to those penalties are often the people least capable of absorbing them. A wealthy customer barely notices a fee. A struggling worker may lose grocery money because of it. But from the institution's perspective, the behavior is statistically predictable, and predictability is monetizable. This is why low-balance customers often experience aggressive fee structures, stricter account rules, lower trust, fewer exceptions, slower customer support. At this stage, the bank does not yet see you as a long-term financial partner. It sees uncertainty. And uncertainty inside banking is treated carefully because banks fundamentally dislike unpredictability. That's one of the most important ideas in this entire conversation. Banks are not emotional institutions. They are probability machines. They calculate risk constantly. Every swipe, every deposit, every missed payment, every transfer. Your financial life slowly becomes a behavioral profile. And at the bottom tier, that profile usually communicates one thing: fragility. Then something subtle begins to happen. Not when you become rich, when you become stable. A direct deposit starts arriving consistently every month. Suddenly, your banking experience changes slightly. Not dramatically, but enough to notice. Your credit limit increases, You start receiving pre-approved offers. The tone of the emails becomes friendlier. Your app starts suggesting financial products. And psychologically, this creates an illusion. People think, the bank finally trusts me. But trust isn't the right word. The bank can now model you more accurately. That's the difference. Consistency is incredibly valuable in finance because predictable people are easier to lend to, easier to market to, easier to profit from. A worker earning moderate income consistently may appear safer to a bank than someone earning large amounts unpredictably, because stable cash flow matters more than temporary spikes. This is where many people unknowingly enter the modern debt economy. The bank begins expanding access. Car loans, installment financing, higher credit cards, personal loans, buy now, pay later systems. Everything starts becoming easier to obtain. And it feels good. That's important. The system is intentionally designed to feel empowering. Because once credit feels normal, borrowing stops feeling dangerous. A monthly payment begins feeling smaller than the total cost. A 5-year loan starts feeling manageable. A 30-year mortgage starts feeling standard. Debt slowly transforms from emergency tool into lifestyle infrastructure. And most people never notice the psychological shift happening underneath them. The system no longer asks, can you afford this? Instead, it asks, can you survive the monthly payment? Those are completely different questions.
Then, eventually, your financial identity becomes condensed into a number, a score. 3 digits that quietly influence huge portions of adult life. And what's fascinating is that your credit score isn't really measuring wealth. It's measuring behavior. Specifically, repayment patterns, consistency, utilization, age of accounts, debt management, financial discipline. 2 people can earn identical incomes and be treated completely differently by the system. One receives low interest rates. The other gets punished with higher borrowing costs. And over decades, that difference compounds massively. A person with excellent credit may save tens or hundreds of thousands in borrowing costs across a lifetime. Not because they're smarter, not because they work harder, but because the system perceives them as lower risk. And lower risk receives better reality. That's the hidden truth most people never fully realize. Money changes the environment around you. Better rates, better insurance terms, better approvals, better housing options, more flexibility, more forgiveness. The financially stable often experience life as smoother, not because they face fewer problems, but because institutions respond to them differently. At this level, banks begin introducing premium experiences, metal credit cards, airport lounges, reward ecosystems, priority support, cashback programs, travel benefits. And this is psychologically brilliant because debt no longer feels stressful. It feels prestigious. You are no longer merely borrowing. You are participating in a status system. The card itself becomes identity. And banks understand human psychology extremely well. People will often spend more to maintain a self-image than to satisfy actual need. That's why premium financial products are designed emotionally first, financially second. Luxury packaging, exclusive terminology, VIP branding. Everything communicates status. Because status drives engagement, and engagement drives spending.
This is the stage where many people appear financially successful while becoming structurally trapped underneath the surface. Income rises, lifestyle rises, expenses rise, debt rises alongside everything else. A better apartment, a newer car,
higher subscriptions, bigger payments. And from the outside, life looks upgraded. But internally, many people are operating with extremely thin margins. Because modern financial systems reward visible consumption, not quiet resilience. A person driving an expensive car financed over 7 years may appear wealthier than someone with substantial savings driving an older vehicle. Banks understand this dynamic perfectly because visible lifestyle inflation creates long-term borrowers, and long-term borrowers are valuable. This is why many middle-income professionals experience a strange contradiction. They earn more money than ever before, yet still feel financially anxious. Because increasing income without increasing ownership often changes appearance more than freedom. And this creates the most psychologically exhausting financial zone in society. Not poverty, not wealth. The in-between stage where you appear stable, but one emergency could destabilize everything. At this level, people often begin believing they are failing personally. But structurally, many are simply participating in systems designed to normalize permanent payments. Monthly payments become permanent background noise. Car payment, phone payment, insurance payment, subscription payment, mortgage payment, credit payment. Everything becomes recurring, which means your future labor slowly gets sold in advance, 1 month at a time. And the dangerous part is, modern systems make this feel normal. Not alarming. Normal.
Then, eventually, another threshold gets crossed. And this is where the system becomes fascinating, because somewhere between high income and real asset ownership, the relationship reverses. You stop chasing the bank. The bank starts chasing you. Relationship managers begin calling. Exclusive investment opportunities appear. Fees disappear quietly. Exceptions become easier. Customer service becomes dramatically faster. And suddenly, you realize something uncomfortable. The rules were flexible the entire time, just not for everyone. At this level, the institution sees you differently because your money itself becomes strategically useful. Large deposits strengthen banks. Investment accounts generate management fees. Business ownership creates entire financial ecosystems. The institution no longer views you merely as an account holder. You become a valuable node inside the financial network. And valuable nodes receive protection. This is why wealthy clients often experience waived fees, customized lending, lower interest rates, personalized service, rapid approvals, direct communication channels. Not because banks are generous, because retention becomes important. A wealthy customer leaving can cost an institution millions over time. A low-balance customer leaving changes almost nothing. That single reality explains enormous differences in treatment. And once people experience this higher level, many never look at banking the same way again, because they realize the institution was never truly rigid. It was selective. Then comes the level most people hear about, but rarely understand. Private banking. To the average person, it sounds luxurious. And yes, there is luxury involved, but the real advantage is efficiency, access, speed, coordination. At this level, wealthy clients may receive dedicated advisors, customized credit structures, investment-backed loans, estate planning coordination, tax optimization strategies, private investment access, concierge-style financial support. And the most shocking part? The people who least need loans often receive the cheapest loans. Because the wealthy borrow differently. Instead of selling assets and triggering taxes, they often borrow against existing wealth. Meaning assets continue appreciating while liquidity remains available. This creates a completely different financial reality from the average consumer experience.
A struggling person may pay extremely high interest during emergencies. A wealthy investor may access massive liquidity at comparatively low rates because the bank views them as highly secure. Same institution, different mathematics. And this is where the hierarchy becomes undeniable. The cost of money itself changes depending on how much money you already possess, which creates a compounding effect. Wealth generates access. Access generates opportunity. Opportunity accelerates wealth further. Meanwhile, lower tiers experience higher friction, higher penalties, and higher borrowing costs. The system literally becomes easier to navigate as resources increase. And none of this is accidental. Financial institutions are engineered around risk optimization, not equality.
But above all the technical systems, there's one final transformation that matters most: psychology. The wealthiest people often interact with banks completely differently emotionally. No intimidation, no fear, no panic when checking balances, no anxiety opening emails. Because scarcity changes the nervous system. A person living financially exposed often experiences constant low-level stress, checking accounts repeatedly, worrying about unexpected charges, fearing emergencies, delaying medical expenses, calculating every purchase mentally. And over years, that stress compounds psychologically. Meanwhile, people with substantial financial cushions experience something invisible but powerful: time to think clearly. And clear thinking changes decisions. This may be the greatest privilege money creates. Not luxury, reduced fear. Because fear shortens decision-making horizons. People under pressure often prioritize immediate survival over long-term optimization. And financial systems quietly profit from desperation. Late fees, high-interest debt, panic borrowing, emergency financing, all become more common when stability disappears. Which means emotional control itself becomes financially valuable. So, after all this, what's the real takeaway? It's not that banks are evil, and it's not that wealth automatically makes someone better. It's something colder than that. Banks operate according to incentives. They reward predictability, assets, stability, profitability, low-risk behavior, and depending on where you stand inside that framework, your reality changes. The higher you rise financially, the softer the system becomes. Lower fees, faster approvals, cheaper debt, better treatment, more flexibility, more forgiveness. And once you see that clearly, a lot of modern life suddenly makes more sense. Why poor people often pay more for access to money. Why wealthy people borrow cheaply. Why institutions become friendlier as balances rise. Why some people experience the financial world as opportunity, while others experience it as constant pressure. But there's one thing no institution can fully control: awareness. Because once you understand the incentives underneath the system, you stop taking everything personally. You stop confusing credit with wealth. You stop assuming luxury means freedom. And you begin realizing something most people never fully understand. The real game was never just earning money. It was understanding how money changes the behavior of the world around you. And once you see that, you can never unsee it again.